Hello students, a very warm welcome to all of you in this lecture 2 of chapter number 9. The chapter is financial management. We had done first part of this lecture or this chapter yesterday in the previous class, I mean to say. And let me revise it quickly, whatever we had done in the previous class, and then we'll go ahead with the proceeding of today's classes. Okay, so we had seen what is the meaning of financial management. What is financial management? Financial management has two things in itself. One is finance and other one is management. So this function is basically related to the management of finances. Procurement of the finances is one thing. Then procurement from what kind of sources we'll be doing and how we are going to utilize them in the most effective manner. This is what is financial management. And two functions of management, right, which is planning and controlling, are most most prevalent over here. You can see it very widely over here in financial management. Now, what is the importance of financial management? Why it is important to have financial management in your business? And whenever I'm saying business here, we are basically concerned with the companies. We are not talking about the small form of organizations like your sole proprietorship or the whole the sole proprietorship or partnership. We are talking about the company structure of the business. So importance is it tells us size and components of the fixed assets and the business, in which kind of assets the money should be blocked. Means there should not be excess blocking of money into the fixed asset, and it should not be too little. So both extremes are not good. This is what the financial management tells. And the financial management also tells that the quantum of current assets and its breakup into cash, inventory and receivables. It will tell us what kind of implications if we have certain funds in cash or other places, how it is going to affect the business. Then it also tells us the breakup of long-term financing into the debt and equity, that how much percentage of our long-term finances should be coming from the debt and how much it should be coming from the equity, etc. It also tells the amount of long-term and short-term finances to be used. Means for what kind of purposes company should be using the long-term sources of finance, and for what kind of purposes company should be using the short-term of finances. Then at last we had done what is the objective of financial management. So we had discussed three objectives of financial management. One is profit maximization. So we were talking about increasing EPS. Next was wealth maximization, and other objectives can be reducing the wealth, etc. So this is all we had done in previous class. Now today, what are we going to do? Today we are going to do the further studies. Okay, so let us start today's class with the further studies. We had completed here. We have revised also what we had done yesterday. Now, financial management is, as we discussed in the meaning itself, that financial management is about deciding about few things about the finances. So decision is always involved in financial management, because yes, we talked about planning and controlling. What did we say? That two managerial functions, two management functions are very prevalent and very prominently seen in financial management, that is planning and controlling. And whenever we talk about planning always involves decision making. So in financial management, a manager or a person in charge for the finances of the organization will be taking basically three kinds of financial decisions. So financial decisions can be what? Let us see this in detail. So financial decision is one of the most important decisions that a finance manager of an organization exercises. So whosoever is in charge of the finances or the financial manager will be taking the financing decision. The financial decisions of the company are determined by and are concerned with the three important decisions. So what are the financial decisions? So there can be three financial decisions which are most important. Number one is related to investment, number two is related to finance, and number three is related to this dividend. Now let us see one by one each one of these. Investment decision. What is investment? Investment means for running your business smoothly, you will have to make the investment that everybody knows. what kind of this investment you will have to do. You will have to procure your fixed capital that can be buying a building, plant, machinery, assets, or whatever is required depending on what is the nature of your business. If you are a manufacturing concern, you will require heavy amount to be invested in kind of form, in form of plant, machinery, etc. If you are a service industry, you will mostly invest your money into intangible assets like softwares, etc. And in human resources, we'll be investing a lot. And working capital requirement is also there. So in working capital, you will be investing. So investment decision is basically bifurcated into two different parts. Number one is capital budgeting. Capital budgeting is referring to the blocking of money into the fixed asset, etc. And working capital management means day-to-day functioning of the business. Regarding that, whatever money is required, that is called working capital management. Later on, financing decision. Now we have decided that we need to invest this much of money. But from where are we going to arrange that money? As we discussed in the previous class, for a joint stock company, there are numerous resources available for raising the money. So out of those available resources, what kind of resources can be opted by the company and what will be the associated cost that will come under cost of capital. So what is cost of capital means if I borrow money from the financial institution, so what is going to be my cost of capital? Initially, whatever processing fees for raising the loan I'll have to pay the financial institution is going to be called my cost of capital. And on the regular intervals, what interest I have to pay to the financial institution is my cost of capital. Now, if we talk about the capital structure decision, capital structure is like you can say your portfolio. So in your capital structure, what percentage is from the owned capital, what percentage is from the borrowed capital, and under borrowed capital also we had discussed in brief yesterday that there are two kind of sources available to you, or rather three kind of sources available to you: short-term, mid-term, and long-term sources of finance. So what kind of capital structure you should have means there should be a balance, and what balance should be struck by the company. That all decision is called related to financing decision. And the last one is leverages. What is leverages? This we are keeping on hold right now because it is a very lengthy and very interesting and important topic. So this we will discuss in detail in the coming part of this chapter. Now the last decision regarding the financial decision or financial management is dividend decision. So dividend, you must be aware, is dividend is that part of profit which is paid to the shareholders of the company. So how much dividend should be distributed among the shareholders? There is no fixed policy as such which is given by the law, but each and every company follows their own policy that whether they are going to pay dividend on the regular basis or they will not pay dividend on the regular basis. Are they going to have a fixed dividend policy, or they are going to keep it fluctuating every year? So all this is internal decision by the company, which may have impact on the share prices as well. So that is again an area of expertise of the financial management. So financial manager will have to decide all this. And retained earning. What is retained earning? That out of the profit which you have earned, how much you are going to distribute as dividend among the shareholders and how much you are going to retain with you. So let me give you an example. All of us are aware of Facebook, and many of us are using it also. So Facebook is a big company. Okay, out of Facebook, Facebook does not give dividend to the shareholders very frequently. Same is the case with the Reliance also. Reliance also does not distribute dividend very frequently to the shareholder, and not a very big amount of dividend is distributed among the shareholder. But still these companies are growing. What is the reason behind it? Because they have very diversified business and they have good projects in hand. So what they believe in, that instead of giving little amount as profit to the shareholders and increasing their EPS, remember very carefully what we had learned about EPS yesterday. If you do not remember, let me remind you, objective of financial management is to increase the profit or profit maximization. There we had read this word EPS. So instead of increasing EPS of the shareholder, these companies like Facebook and Reliance, they believe in wealth maximization. And what they do, they retain that profit, and that profit is invested elsewhere into more profitable businesses. then what is the result? What happens because of this? Because of this, the shareholders' wealth will maximize because company is diversifying itself. Company is putting its money into more lucrative projects and earning more and more profit. So what will happen? Shareholder will not get instantly little amount of dividend, but this is a possibility that the share which is bought for 2,000 rupees is being sold in the market for 5,000 rupees. So what is happening? The shareholder is ultimately gaining, but not gaining, not in form of EPS, but instead in wealth maximization by increasing the share value. Okay, so these three decisions are the major decisions which a company takes, which every company will have to take. And financial management or financial manager is basically concerned with these kind of decisions. I hope students, you are getting this. And if any point, if you do not understand, you pause it over here, read from the book, and you can replay the video. So let us start with investment decisions first of all. What are investment decisions? So each and every organization has limited resources in comparison to the users of the resources. Yes, all of us have studied somewhere in the economics that economics is what? Economics is scarcity of resources and unlimited want. This is a trade-off between the scarcity of resources and unlimited want. This exactly happens with the finances. The companies or any organization has unlimited wants as far as finances are required, but finance is not available in abundance, means you will have to pay the cost for raising the fund. So this is what is happening, and that is why we have to take the investment decision. What does it say? Let us read again. Each and every organization has limited resources in comparison to the uses of the resources. Everybody wants finances, but it is not in that much of quantity, so we have to use it carefully. So it is very important for a firm to decide the source in which the fund should be invested as to fetch the best return. So we have to see where should we invest our fund so that we can make the most of our money and we can get the good returns also. So return on investment is talking about. So if I put 5 rupees into some project, I should be able to make out of that 5 rupees, 7 rupees, 8 rupees, 9 or 10 rupees, whatever is possible. It should be giving me more money. Okay, so investment decision has long-term and short-term decision involves in it. For long-term decisions have capital budgeting, and short-term means it is related to the working capital. Next point written about the investment decision is investment decision is an organization in an organization are taken in both long-term and short-term. Yes, we know this. So there are two types of decisions. Long-term decisions, these are also called capital budgeting. So whenever the word capital budgeting comes, what should be the associated word which should come in your mind is capital long-term decision. So this also implies that the funds are invested in a resource for a longer period of time. These decisions affect the profitability and size of assets. So how it is going to affect the profitability? Let's say, let me take an example of a construction company. If there is a construction company which requires JCB machine on very regular basis, then it is better to buy that machine instead of hiring it. So what investment decision it will have to make? It has to make a decision whether it should be investing money into buying a JCB machine. It's a big machine. It is a costly machine, whether they should buy it or not. So the answer will be because you require it regularly and it is one of the essential part of functioning smoothly and increasing profitability. Otherwise, what will happen? You will have to pay high lease charges. There is a possibility that sometimes you don't get the machine on hire at the time when it is required in your project. Then your project may get stuck for a couple of days. Some delays can be there. So it is better to buy your own machine. So what it is going to do? It is going to increase the profitability. And it also depends, long-term investment decisions also invest. It depends on the size of asset, what size of asset you are buying. So both these things have to be kept in mind. And who will take this decision? Obviously, the finance managers or the top level of management of the company will have to take these decisions. Short-term investment decision. What are the short-term investment decisions? These are also known as working capital decision, and these are equally important. Though there will be less money required, less investment required, but this is not the case that these decisions are not important. They are important because for day-to-day functioning, you require your working capital, and if there is no smooth flow of working capital, then what may happen? Your work can get stuck stuck. The smooth functioning can stop. This also implies that funds are invested in the resources for a shorter period of time. These decisions affect the day-to-day operations and activities of an organization. It also affects the liquidity and profitability of the business. Let me give you an example of short-term sources of finance. For example, you are a sugar mill. So sugar mills will have to arrange for a large amount of working capital in the peak season, because if we talk about the sugar cane is not available throughout the year. Whenever the crop comes, whenever the harvest comes, at that time you will have to buy and procure material, your raw material, and the production has to go on. So at that time you will require a large amount of working capital. At that time you may even have to hire some casual laborers which are not your permanent labor. So at that time, if you have not arranged working capital properly, what may happen? This may reduce your profitability. Why? Because you will not be able to hire the extra labor. You will not be able to buy the raw material at the right prices. So it is so important for smooth functioning of the business. Both the decision, we cannot make any comment like that long-term investment decisions are more important or short-term investment decisions are lesser important. Both are equally important for us. Then let us see what are the essential contents of the working capital. So under working capital, we have three areas: inventory management, receivable management, and efficient cash management. Inventory management means when we talk about how much inventory to hold and how frequently the orders should be placed. So see, for every business to run smoothly, we need to maintain a minimum stock of inventory. That depends on the business, what kind of business you're running. If your inventory is perishable inventory, you cannot hold large stock of inventory because it will get spoiled. If your inventory is not available throughout the year, then you will have to have substantial amount of your inventory in hand. Otherwise, in their off seasons, you will not get it. If your inventory is available throughout the year, then you will have to procure inventory in different parts of the year. All that depends on what kind of business you are doing. When we talk about receivable management, so here we are talking about our debtors and bills receivables, etc. So how much credit period to be granted to them so that we can recover the money and that money can be utilized into our working capital. Because as a tradition of the business, you have to give, because most of the other businesses, if they are giving their goods on the credit basis to the debtors, we also will have to give. We cannot do the business on completely cash basis if it is not a tradition into your industry. Then how much credit period should be around? Efficient cash management, then smooth running of the incoming of cash and outgoing of cash. It should be planned properly. How it can be done? By making cash registers, etc. One way of doing this can be there. So all these are the areas which are related to the working capital management. Now, let's see factors which affect the capital budgeting decision. What is capital budgeting? I had told you, whenever we listen to the word capital budgeting, what the associated word should come in our mind is long-term investment decision. So what are the factors which will affect the capital budgeting decision? So first of all, cash flow of the project means for which project you are taking this investment decision and how much money you are investing into the fixed asset, etc. It should not cost too much of blocking of the funds, because you will have to see that how much regular cash inflows are there. Let's say I take a loan of 2 crore rupees and every month I have to pay, let's say 5 lakh rupees as EMI. But I earn only 3 lakh rupees per month. Then how I'm going to pay 5 lakh rupees? It's not possible. In fact, if I'm earning 3 lakh rupees, that all 3 lakh rupees also cannot be my EMI. Why? Because just because paying some EMI, I cannot stop the regular expenses of business. If I have to pay the salaries to my worker, I'll have to keep on paying. If I have to pay my electricity bill, I'll have to keep on paying. If I have to procure the raw material, I'll have to keep on buying raw material. So this all expenses will not stop. So what is very important that before taking any long-term investment decision or capital budgeting decision, we have to see that how much cash flow is there in the business, what is the position of cash flow, and accordingly we will have to think that how much we will be able to repay. Are we in position to pay or not? Then next important point which you have to see while taking any by making any investment into the capital budgeting, rate of return. This is one of the most important factors to be considered before investing in any venture. These are based on the expected returns and risk involved in each proposal. So let's say we are buying a machine, or let me give you more relevant example. Nowadays, you must have seen in many of the houses, they follow this solar panel system where you don't have to buy the electricity. You install the solar panels, they will generate the electricity. That electricity will be consumed by you directly, or you can send it to your local electricity board, and then you can trade off with them that they will not charge you for your bills or whatever electricity you are generating, you are consuming. And if there is any shortfall in the electricity generation by you, only the excess amount which you have consumed, you will have to pay that. So these solar panels are initially expensive, but they recover the cost in couple of years. Let's say on an average, if there is a big house where a lot of ACs are used and all, on the peak season, let's say 25,000 per month electricity bill is coming, and the solar panel is going to cost you, let's say 10 lakh rupees. So you will have to think that this 10 lakh rupees is going to be recovered in how many years? Whether 3 years, 4 years, 5 years, after that it will become free. You have recovered your cost. How you have recovered the cost? If 25,000 per month you are paying the bill, so 25,000 into 12 if you do. So in how many months you are going to recover the cost? So 25,000 into 12 means 3 lakh rupees per annum your electricity bill is there. So 1 year, 2 year, 3 year, and 3.5 years. In that much period of time, you will recover the cost. So 3 plus 3 plus 3, 9 lakh rupees. And in the next year, you are going to, for 3.5 years, you will be able to recover the cost of installing this solar panel. So you can say like this. So rate of return of any project is calculated like this only, that how much risk is involved, how much is the promised return, that this much we will get. So company always have to do this analysis before they make any investment. So I gave you example of solar panel like this for companies. If they are buying, let's say they had a semi-automatic machine of producing something. Now they are buying fully automatic machine. So they will have to see that how many operators were required for the previous machine. Now how many operators are required for the new machine. Let's say the previous machine required 3 operators. The new machine requires only 1 operator. New machine is more fuel efficient. It does not consume so much of fuel. If it is run by electricity, it consumes less electricity. It has more production capacity, but it requires more repairs and maintenance. But previous one did not require more repairs and maintenance. All this you will have to, you will have to compare. If you sell the previous one, how much you will receive. This one has how much of shelf life and all. All these decisions you have to take. So that is coming under rate of return. Next is the investment criteria involved. What is your investment criteria? It is important to evaluate various investment proposals by considering factors like interest rate, cash flows, etc. So suppose you have 3 proposals in front of you, proposal A, proposal B, and proposal C. Each one of them are giving you machines at different rates. Some are giving you upfront for cash, some are giving you on the credit basis, some are giving you credit basis with some interest, some are giving interest-free rate, etc. So all this you will have to compare and then reach to a decision. Always Asta is good is not the case. Suppose I have 3 proposals, 5 lakh, 3 lakh, and 2 lakh rupees. So I should not blindly go and opt for 2 lakh rupees, because it is a possibility that the 2 lakh rupees machinery requires a lot of repairs and maintenance. 2 lakh rupees machinery requires a lot of electricity to be consumed. It's simply like, for your understanding, if I tell you, you're buying an AC for your house. So if you are buying a 2-star or 3-star AC, that may cost you lesser in comparison to a 5-star AC. But what will happen? Your initial cost for a 3-star AC is going to be less, but later on, the electricity consumption will be very, very high. So what is happening? You're ending up paying high amount of money. Whereas for 5-star AC, you will pay initially high, but later on, because of its efficiency, it will consume less electricity and you will be saving actually. And that saving will be throughout the life, okay, of the AC. So this is what we have to compare. Various proposals we have to compare, and then we have to reach to a decision. Students, I hope you all have understood what I'm trying to explain over here. If there is any problem in understanding, you must stop over here, refer to the book. Everything over here, what is written, my notes are from NCERT book. So you have to refer to NCERT book. read and read again, read from here. And as I told you previously also, if you have any problem in understanding, you have to replay the video and then see it, and 100% sure your doubt will be resolved. And even if your doubt is not resolved, you can always go for doubt support. You can reach to me, you can drop a message to me. I will definitely reply. For attending the calls, I shall not be available. So you can just drop a message. I will reply to your messages. Okay. Let us move ahead and do the financing decisions now. So now next one is financing decision. What is financing decision? Remember that we had discussed that under financing decisions, we will have to think that what kind of sources of finance can be utilized or used by the company for arranging for capital budgeting decisions and for working capital management decisions. So under this, financial managers of the organization decide the sources from which to raise long-term funds. The main source of funding is shareholders fund and borrowed funds. Now, what is shareholders fund? Understand, students, shareholders fund means there are two things referred over here. One is raising share capital and asking public to pay. Another one is the reserves which company has not distributed as dividend among the shareholder. So various kind of reserves and surpluses, they also come under the shareholders fund. So company has two resources available under shareholders fund. One is raising capital through issue of equity or preference share. Other one is having the utilization of reserves and surpluses which company has. What is borrowed fund? Borrowed fund means taking from outsiders. Who are outsiders? They can be investors like debenture holders, public deposits, or they can be commercial bank, they can be financial institutions, they can be non-banking financial institutions as well. Shareholders fund include share capital, reserves and shareholder surpluses and retained earnings as we discussed, and borrowed funds use the funds through the debentures and other forms of debt. The decision of raising funds from various sources in appropriate proportion lies in the hands of financial managers. So financial managers have to take a cautious decision that what kind of sources of finance should be used for raising the funds. Interest on loan has to be paid regardless of the profitability of the project. So whenever we are borrowing money from the outsiders, means we are using the borrowed fund, we have to always bear in mind that we are fetching a fixed liability for the company, that we have to pay interest to the share or to the investors regardless of the profit earning capacity of the organization. So in case when there is less profit or there is insufficient profit or there is loss, we cannot deny paying interest. We will have to pay the interest because it is a fixed liability. Then debt is considered to be cheapest form of finance. Why debt is considered to be cheapest form of finance? Because see, imagine a situation if your company has launched a good project, raise funds from that by raising loan from the commercial institution or any other non-banking commercial institution, and it is paying interest and it is going on increasing its profitability. Profits are going on increasing. In no condition the lenders or the investors who have paid the money to us can come and ask us to raise the rate of interest, because what was decided was it will remain fixed. That is why it is considered to be cheap. Otherwise, if we talk about equity shareholders, you will have to keep on giving them dividend, or you will have to try to maximize their wealth. Okay, they are the shareholders, means owners of company. Their voting right also. What are these people? These people don't get any voting rights. These people cannot ask for the raise in the rate of interest. Whatever is the profit of company, they will get their returns by a fixed rate only. And plus, they are not going to be there with the company throughout the life of company. They will be paid back after few years, 10 years, 20 years or so. And after that, company will be loan free. Okay, so they will have no say in the company's management, etc. So this is why it is called cheapest. Financing decisions, what are the factors which affect the financing decision? So same like what we had studied, what are the factors which are going to affect the capital budgeting and working capital decision? Same here, we are going to study for financing decisions, what are the factors which will affect. First of all, cost. So cost of raising funds. We are talking about cost of capital over here. that how much cost has to be incurred initially and later on, which is a perpetual cost, means year after year, which you have to pay on the regular basis. So one-time cost is like, processing fees, etc. when you are issuing the, let's say, debenture. So at the time of issue of debenture, whatever one-time expenses you have to make on issuing the prospectus, advertisement, etc., that is cost of finance. And later on, the interest which you have to keep on paying to the debenture holders, that is another cost. Okay. So cost of raising funds influences the financial decision. A prudent financial manager selects the cheapest source of finance. So normally, the managers go for such sources of finance where do not have to invest so much of cost of capital. Risk. Each source of finance has a different degree of risk. So we'll have to see how much risk we are able to bear. How much risk we are ready to bear. Okay. So what we have to do? We have to be very, very cautious that in deciding that what kind of risk we are able to bear it. Like, for example, what is written over here also, that borrowed funds have high financial risk. Why? Because if you are not earning any profit, you are not liable to pay anything to the shareholders, because dividend is what? Dividend is part of profit. So if there is no profit or insufficient profit, you can stop giving anything to the shareholders. You are under no legal obligation. In fact, when profits are there, at that time also the company can decide not to just distribute dividend and utilize these funds into some other good projects. But for borrowed fund, which you have taken from any financial institution, debenture holders, etc., there is a risk. Risk what means there is a compulsion that you have to keep on paying the interest, otherwise you will be under trouble. So this is one. Now, flotation cost, about which I had discussed in point number 1 also. Cost of capital is what you have to keep on paying on the regular basis, like interest, dividend, etc. Here they're talking about one-time cost, which initially at the time of flotation means launching or issuing, you will have to invest, incur. That is called flotation cost. A financial manager estimates the flotation cost of various resources and selects the sources with least flotation cost. Means flotation cost in case of shares. If I tell you, when we issue the shares, we have to advertise for prospectus, and we have to take services of underwriters. We have to take services of various other people like bankers, etc. So to all of these people, whatever you will pay, that is called your flotation cost. Let's say I'm issuing my shares, I'm a company and I'm issuing my shares to public, IPO I'm taking out. So initial public offer, before I take out, I will have to issue the prospectus. I will have to show, advertise this prospectus in the newspaper, on various social media platforms, or in various e-portals, newspapers, etc. They're all on billboards and etc. I'll have to advertise it. I'll have to call people to invest into my company. So making this prospectus, first of all, will be the time taking and money consuming process. So there will be cost involved. Second thing, for advertising this, I'll have to involve the cost. And because this under this prospectus, whatever is written has to be certified by the people, has to be justified by the people. They cannot be just signing just like that. They will do the analysis, they will sign, and they will be responsible for the things written over here. So I'll have to pay them also their fees, etc. So all these things I will have to take into consideration, and I have to judge that how much flotation cost and how much fees I will have to pay to the various people. Okay, so this is what is called flotation cost. Next is cash flow position of the company. So as we discussed in the capital budgeting also, here also we'll see what is the cash flow position of the company. So under cash flow position of the company, we have to see that are we able to pay the interest, are we able to bear the other costs which this source of finance is going to bring on us. So this is very important. What is written over here, let us read. A business with a strong cash flow position prefers to raise funds from the debts. If it has a strong cash flow position, it knows that every month this much of cash flow inflow is there, then it can easily go for paying to the interest on the debt because it's a fixed charge. But if it is on the contrary, does not have a strong cash flow position, in that case, it will have to go for paying, it will have to go for other sorts of finance other than debt, like issue of shares, etc. Fixed operating cost. What is fixed operating cost? For a business with high operation costs, funds must be raised from equity and lower debt financing would be better. Means any business which has operation cost very high. Okay, for example, airline industry. So airline industries have a very high running cost. Running cost means the fuel prices are high, the hangar charges are high, and all other expenses are much higher than any normal industry. If I compare an airline industry with fast moving consumer goods, there is a huge difference. So their operating cost is very high. That is why they cannot go for sources like, not ideally in all the cases, but preferably they will not go for borrowed fund, because in borrowed fund there is high risk involved. So they should go, these kind of companies where operating cost itself is very high, they should go for sources of finance where they do not have to bear a very high cost of, as a cost of capital, as interest, etc. Then control consideration. What is control consideration? See, at the moment you issue the shares, you are giving them voting rights, and these people will be your shareholders who will be holding the voting rights. So if any company does not want to dilute its voting rights and does not want many people to have voting rights, it will not go issue the shares for the purpose of raising fund. It will go for issuing debentures or other kind of instruments for raising the funds. So see what is written. A company would prefer debt financing if it wants to retain complete control of the business with the existing shareholders. Means they do not want more people to come and become shareholder and have voting right. On the other hand, if a company is ready to lose control, means it is ready to share with many people rather than lose, I will use this word, it can raise funds from equity. The last point, state of capital markets. Very, very, very important. See, what is state of capital market? If we want to raise capital through issue of shares, but the stock market has crashed down, it's not in a good state. People are not having faith in the stock market and they are very depressed with the performance of the stock market. And if we launch our issue of shares, IPO, etc., then what will happen? It will be a failure, because the stock market condition on the whole are not supporting us. It's not that our company's performance has got to do something with it, but it's overall the stock market conditions are not good. So it's not advisable in such conditions to go for issue of shares. Then we should rely on some other kind of sources. Okay. So all these are some of the factors which will affect on the financing decisions. Okay. And obviously, these are some of the general factors. Apart from it, there will be certain factors which will be industry-related factors. So that also need to be taken into consideration, which we are not discussing over here. But in general, I'm telling you that those factors also need to be considered while taking this financial decisions by the financial managers. Okay, students. So refer from your book. Do not forget to read from your book once again. Now, after this, we have other decision, dividend decision. Okay, dividend decision we are not going to do right now, students. So let us revise once again what we did in today's class, and in the next class we are going to do dividend decision. So let's see what all we did today. Today we did what is various kind of decisions taken under the financial management. So there are three basic decisions which are taken under the financial management. Number one is investment decision. Under investment decision, there are two decisions which are taken. Number one is capital budgeting, which is associated with the fixed capital requirement. And number two is working capital management, which is associated with the working capital management. Next is financing decision. Financing decision is how are we going to arrange the funds for these various sources of finance. So cost of capital, cost of capital means how much we'll have to pay. Capital structure decisions and leverages. These three things we have to see under financing decisions, and under dividend decisions we have to see dividend policy and the retained earnings. So we did today investment decisions and financing decisions. We are left with the dividend decision, which we'll do in the coming classes. Okay, till then, have a great day. Bye. We'll meet in the next class and go ahead with the chapter. Okay, till then, keep revising. Bye.